Here we are again. Welcome to Freightonomics, the show, the podcast that we discuss the combination of freight and the macroeconomic influences and how they interconnect and what to make of all of this nonsense. I'm Zach Strickland, Director of Freight Market Intelligence, and with me, of course, is Anthony Smith, lead economist at FreightWaves. And thank you all for watching. Of course, Anthony, you will be viewing LinkedIn to check out any of our viewers that might have some comments, correct?
I'm on LinkedIn. I'm on Facebook. If you want to join into the conversation, if you think something I'm saying is wrong or interesting, something Zach's saying is wrong or interesting, or you just got something completely different that you want to add to the conversation, you can add it there on LinkedIn. We're streaming live, and we always want to hear from you.
Exactly. So, we also like to thank our sponsor, Amazon Freight. We always love to have one of those, so we want to make sure to give them a shout out. Thank you again. Of course, it's coming up on their time of the year. But of course, this year, I think they've had quite a year in general. But thanks to Amazon Freight, after years of fine-tuning their technology, working with trusted carrier partners, and leveraging infrastructure to optimize their logistics, Amazon Freight is now offering shippers of all sizes the ability to tap into their network to optimize your business. Shipping full truckloads with Amazon Freight means reliable capacity, competitive rates, and instant quotes. If you're looking to ship or ready to haul, visit freight.amazon.com to get started. And today's show, what a show we have, Anthony. We don't have any guests today. We'll hold off on that.
Back to basics.
We need a minute to reset. And I think we're going to dive a little deeper today into a topic that I think has become relatively important amidst all this COVID-19 world. And that has, I think, for a lot of carriers, a lot of the feedback we've gotten has been simply the recruitment of drivers has become a pretty big issue here over the last several months. Early in the year in March, April, we had a lot of schools shut down. My kids stopped going to school. They had to do that virtual thing, but it's really hard to virtually train a driver. So they didn't have a lot of options there to get people into these classes. And of course, a lot of people, a lot of these shippers, and some of our, market experts didn't really anticipate the economy and therefore the freight market really returning to the levels that it has over the last several months, Anthony. We are, we're kind of playing catch up in a lot of areas of not just the freight market, but the economy itself, correct?
Correct. Yeah. I think you phrased it perfectly right there. We are playing catch up in a lot of areas, not just the freight economy, but really when we're looking at manufacturing upstream and downstream, especially when we're looking at on the consumer facing side, so closer to downstream, we're definitely playing catch up. We can see that with the shifting and the maneuvering of inventory levels, things that were supposed to be set for a certain season or a certain time of the year are being shifted and kind of moved back. And then, we had that false start earlier on in the year where we thought that this was going to be a full launch and reopening happening. Then that kind of, regressed a bit as things started to close back down again. And so we saw that preparation and then that return of inventory. So it's been a lot of shifting of existing products in addition to trying to push new products into the supply chain.
Exactly. And it's been a very fragmented, uneven recovery at that. Some of these industries have really struggled. The industrial manufacturing segment, of course, as you mentioned, not really coming back online as fast as some of the others, especially the CPG and the food and beverage sectors, both still doing quite well. Home improvement, again, still doing quite well. So we're really still trying to adapt to what's going on. And one of the big hang-ups that I don't think anybody really saw coming, at least to the scale that it has, is the driver recruitment issue. But we'll dive into that here in more detail in a minute. But first up, we've got the story of the day for what I feel is, this is where we talk about really what we feel is the most important freight market story or item that's going to pertain to all of its participants, whether you're a shipper, broker, carrier, in the transportation space here over the next several months, or maybe it's just a current issue. And today's story, of course, Cass, the invoicing company, $28 billion worth of freight spend involved in these invoices with over 800 different providers. involved in that. So it's a pretty strong example, or a good representative, I think, of the space. Cass just had their monthly indexes come out. And the two that I like to pay attention to, and of course Todd Maiden has covered this in more detail on our website, looking at Cass sees freight trends accelerate sequentially in August. For those of you that watch FreightWaves or read our stuff, know that this is not a surprise. August was probably one of the strongest months in terms of volume rises for the freight market, at least in terms of our OTVI, our outbound tender volume index. We had a 10% increase in accepted tenders. Overall tenders increased roughly 20%. So it was a pretty strong month, very robust. We saw maritime really contribute to that quite a bit as well. And there is, and we have a question. Let's get it started with a question.
Yeah, we have a LinkedIn question.
Yeah.
I think Art Tirom. I'm gonna call him Art, if you don't mind, Art.
Go for it.
What do you mean you didn't expect the market to return to normal? The carrier side is getting mauled with insurance verdicts and 2 years of substandard rates. No one would take it lying down.
Yeah, no, I mean, I guess not that we don't expect things to return back to normal, but I guess the speed with which they return to normal, or I wouldn't call this normal.
Yeah.
The speed with which the market, saw these surging freight volumes, get back to really any activity that would put any upward pressure on rates. I don't think anybody was expecting to get this level of rate increase on the spot market this year. We're seeing spot market rates 40 to 80% higher in some cases, year over year, according to truckstop.com. And, tender rejection rates, of course, climbing from their lowest ever point in May at about 2.5%, all the way up to 26.6% here in the last couple of weeks. I don't think anybody saw that coming. And especially, you think about it, and I was no different in the beginning, thinking that we would not see freight volumes surge like they did to actually compress capacity or put pressure on capacity like it did. That's, we all think this like industrial economy, manufacturing, I think I even wrote an article about it way back when about how there's this connection to the oil industry and industrial economy, therefore the freight market. When that's doing well, you tend to have this trickle down effect where freight volumes really, push up. Well, we've really kind of diverted from that in a way. We don't produce things in the United States like we used to. Yes, the oil market has a pretty strong connection to demand and goods, and it especially did a few years ago, and they still do. But that doesn't mean that other sectors can't have anomalous surges like we've seen just recently.
Right.
Home improvement. We've seen, a lot of the CPG, people sitting at home, they're ordering electronics, e-commerce booming because they're now looking around saying, I need to do something. So they didn't expect to see behavioral changes because, you don't know what you're missing.
Right.
With so much of our lifestyle changes here in the United States over the last several months.
A lot of lifestyle changes. I mean, even on day to day, schools are closed. Kids are staying home. They're Zooming.
That Chromebook action that Chromebooks have become extremely important for this online schooling.
So I don't have kids, Zach. So I have a question for you. With Zoom and all this virtual learning happening right now, and I'm guessing some teachers are they also teaching remotely, like from their home?
Yes. So
does this put an end to snow days?
That's a scary topic for a lot of kids out there. But you know what? In my experience so far, ironically, my daughter's school closed today to clean, and they're back in school full session. Except they intermittently will close down if they have somebody test positive, et cetera, and other things for safety reasons. So it's creating this environment of a lot of snow days, if you will, and it's still a very clunky process.
So snow days might be moved to a different type of snow day, like a cleaning day.
Yeah, I think this year we might not see snow days this year, but yeah, I think in the future we'll probably return
Yeah.
as this infrastructure kind of, we get away from, we're a long way. I don't think that's going to happen this year.
Right.
So 2021 winter, I think, is the first time we'll have a
It
chance
has to
there.
be rough though. Like it's snowing, it's blizzard. It's like a blizzard. And it's like, hey, kids, no school today. And in office or whatever, we'll be doing virtual learning due to the snow day.
And again, that requires technology. You have to maintain a consistent level of technology.
Right,
So there is
right.
demand there now for goods that didn't exist before. The changing environment is almost more impactful to the freight market than anything that you would say consistently. Like,
Right.
We are seeing a lot of changes right now, and Cass, of course, showing a pretty big jump in August, almost an 8% jump on the shipments index. Cass shipments index going from 1.01 to 1.09, down still year over year from 1.19. Pretty big drop there, almost a 10% drop. And but still recovering, and it recovered the fastest that it's recovered all year long so far in August. Not a shock to us. Of course, people are going to ask, what's the, we have OTVI. What's the difference between OTVI and Cass? Cass, of course, measures invoices, which have a bit of a lag built into them. Invoicing occurs after the fact, so they have to wait to process all of those. We are tracking tenders, which actually occur before pickup date most of the time, if you want to get it picked up, that is. So tenders are very forward-looking, and they're also, looking at just trucking volume. So these are truckloads, whereas Cass has got a whole slew of intermodal, some ocean stuff in there, LTL, all this other stuff that's mixed in. And that's really, there's definitely differences. It's important to understand those differences there, but the overall impact, or overall trend is basically volumes are increasing. They're on the rise. It looks like things are getting on the up and up. Also on that same note, the Cass line haul index, which measures pure truckload. Now this one is pure truckload.
Mm-hmm.
It's basically the cost of moving freight across the country. That took a nice little jump up, about 2.5% increase, the largest increase since our COVID outbreak. And again, Cass is very, this is a lot of contracted freight rates.
Yeah.
This isn't necessarily as much spot freight rates in there. So, you're going to see a 2.5% rate increase. Well, spot rates account for, no more than about 25% of the market. And they're not going to account for a lot of the volume that you see in the Cass index, because that's a lot of contracted freight handled, with a lot of these larger shippers and larger carriers.
Right. And we're getting more. So one of the things that I really kind of think about as we kind of talk to some of the industries that you spoke about earlier on, some are thriving while some are not. So we saw some anomalies where we see, of course, retail sales of building materials that just kind of skyrocketed throughout quarantine and things like that. And we even have, I think, Wayne Craig here in the comments saying that, he hasn't seen quite, or hasn't, let me see, where is the comment here? He says that he hasn't really spoken to anyone that said that they've seen a lot of increases or much increases in rates. So I'm thinking that could just be some sectors, some isolated avenues that are really kind of being exposed. So like you mentioned, some of those consumer-facing goods are really being hyper-exposed to some products and some activity, while other silos, other verticals really have been seeing just kind of diminished activity overall.
It of course depends on where you are in the country, what kind of commodities you're covering. A lot of carriers, a lot of people don't realize a lot of these carriers are very niche. Their book of business is very heavy to a couple of customers. My experience was no different. Even some of these larger carriers, it only takes a few large shippers to really dominate, their experience in the marketplace. So if you're not exposed to a Walmart or an Amazon, which that's a diminishing thing at this point for a lot of people. It's going to change your experience.
Right.
But the fact remains the same. The end result of all of this is looking at the spot market. When you see spot rates go from $1.50 to $3 a mile in a lot of lanes, and then you see tender rejections, which again heavily biased towards contracted freight, larger shippers, larger carriers going into from 2% to 25%. There is a definite upward pressure. These are two totally disparate data sources. You're seeing DAT so do the same thing. It's, there are going to be some sectors out there. Specific example within our own data, FOTRI, Flatbed Outbound Tender Rejection Index, has been way below the van and reefer rejection rate for the entire time. We have not seen any significant rate increases there on the flatbed sector, of course, heavily tied to a lot of that industrial production. The oil markets, of course, a big driver of that, and the oil markets, of course, have gone to, dust effectively over the last several months. So, again, it's not always, when you get into these specific sectors, you definitely have some exposure situations where you're not seeing what everybody else is seeing. But that also leads me to ask the question, why are you not seeing what a lot of these other data sources are saying?
Right.
And again, I think there was a question about ATA tonnage.
Yeah, there was. But real quick, I mean, we're about halfway through the show, and I just, one of the things you mentioned was, some of the big people that have really been doing a lot of activity throughout this year. Of course, Amazon is one of those, and got to be thankful for our sponsors at Amazon Freight. So thanks to our sponsor, Amazon Freight, after years of fine-tuning their technology, working with trusted carrier partners, and leveraging infrastructure to optimize their logistics, Amazon Freight is now offering shippers of all sizes the ability to tap into their network to optimize your business. Shipping full truckloads with Amazon Freight means reliable capacity, competitive rates, and instant quotes. If you're looking to ship or ready to haul, visit freight.amazon.com to get started.
Nice. Well said. Good segue, too, by the way.
I work on it.
Yeah, so ATA's Tonnage Index, again, there's some differences here between ATA and CAS and OTVI. They're all measuring similar but very different things. They're different angles. ATA, of course, measuring weight, predominantly, which again has LTL in it, not just trucking or truckload. We have also, when you're talking about the weight of shipments, think about this. Shippers trying to get a hold of their capacity, having this unexpected demand. They need to get this freight moving. They start shipping 3/4 trucks instead of full trucks. They can't sit there. Their processes are disrupted. Second thing, they're not shipping that heavy raw material stuff. That industrial production that we're talking about has not pulled fully back online. When we look at our carload volumes on the rail side, which is a proxy for what we, try to use as like a leading indicator to what's going on in the industrial production side, they're recovering, but they're just not recovering as fast as some of the other sectors in the economy right now. So, I mean, there's a lot of different angles to look at things, and just, I think, being aware of what you're measuring, what you're looking at, can also help you, because there are a lot of options out there, and there's a lot of interesting angles on these things, but it's all data, and understanding what your data is saying is extremely important in the process. But we need to get going with what we were coming on to talk about today, even though those are great questions. Yeah. Love the interaction. Driver recruiting. So over the last several months, it's become, actually just recently, from what I've garnered, and some of our data points to this, driver recruiting. Schools were shut down earlier part of the year. Couldn't get that in. We also had some regulations come into play earlier in the year about the Drug and Alcohol Clearinghouse. Now, the anecdotal talking points aren't really saying that Drug and Alcohol Clearinghouse is having that big of an impact, just yet. But you have to think, when I'm looking at our employment levels for the trucking sector versus construction, for instance, construction has recovered at a much faster pace than the trucking sector. And I have to think that at some point, some of these, not to say that, I mean, when you get into an area where you're going to have a little bit more requirements, Drug and Alcohol Clearinghouse is going to now put some pressure on you to, be a little bit cleaner in the lifestyle. Construction, now there's other options out there that don't have these same requirements. Not that I'm not happy that they're not making sure these drivers are safer. That is not the point. But it may put some constraints on the available pool that you can pull from. And the fact that employment levels for trucking, and this includes back office and everything in too. So maybe some of these recruiting efforts are also leading to lack of bringing people back.
Yeah, I mean, and when we're looking at employment, I think you hit on a really good point there. In economics, there's definitely some pools of labor that are, I wouldn't say transferable skills, but, suitable substitutes where, you might, drive trucks, but you might have a background also in carpentry or construction, and maybe you can kind of leverage one when the other one is you have different streams of income, and you can like kind of go back and forth between which one is more lucrative at the time. And I think that is definitely two fields that many people can kind of go back and forth with. I've met a couple people that have been very active in the trucking community, but also very active in the construction side as well.
And your cousin.
Yeah.
He's flatbedding it out there.
Yeah, that's right.
But he's got his own truck. He's got that investment. Lock that down.
That's right.
And that's not who we're talking about right now. Those guys are out there. There's different challenges involved with that. The owner ops side, of course, insurance costs, as our viewer mentioned earlier, have really gone up this year. A lot of that due to the fact that we have nuclear verdicts and things like that really going haywire in recent years. And, for me, in terms of this larger carrier environment, they have recruiting departments, something that people may not be aware of, especially if you're on the other side of the equation. There's not a lot of industries or companies out there that specifically have full staffs dedicated to hiring one single position.
Yeah.
They'll have it's normally called human resources.
Right.
And they're in charge of recruiting for the entire company. But trucking companies, these larger carriers, have recruiting departments specifically designed to hire and train or hire and bring on drivers. And it's not just recruiting, but it's background checking, all sorts of other stuff that goes into that. So the cost of hiring a driver can be tremendous. When you're talking about an experienced over-the-road driver, you're talking about $10,000 to $15,000 to hire them. When you're talking about a new recruit, you're still talking about $6,000 to $8,000 a pop. There's a lot of costs involved in that. And if these carriers have to consistently maintain this high level of, recruiting and activity, those are two departments right there alone that are going to add to the increased cost burden. And turnover. Of course, driver turnover, a lot of people don't know this, but that are outside the space, but anybody that's worked at a carrier knows that driver turnover rates of 100% are not uncommon. And what that means is that you turn over your entire staff of drivers in numbers. Not everybody doesn't just quit all year and you have the different people every year, but the amount of drivers that you are hiring each year is the equivalent to the ones that you lost.
Yeah.
Which is just really hard to fathom. And that's some of that added cost burden that you just I don't think a lot of people think about.
Right.
So, and I don't want to just harp on the fact that this is bad and, some of these challenges, but sustainability over the last couple of years. You're talking about drivers that last year at this time were complaining about, not having anything to do, deadheading more, having empty miles, basically being worried about utilization, to not being able to keep up.
Yeah.
And then they know that 2018, if they were involved in that, same thing. So you have these wild swings in the market over the last 3 to 4 years. We've seen some most significant swings in the market. That's going to keep a lot of people, not necessarily in that space. They're going to be like, you know what, I'm going to make a lot of money one year and then nothing the next. It's going to cost me money the next. It's a very difficult thing to deal with. And then, of course, there's the whole remote living thing. Anytime that you're dealing with a large population of people, and I'm going to get my psychology out on you now.
Let's hear it.
And this is very relevant even to the back office here in 2020. Anytime you're dealing with a large amount of the population, being remote and disconnected from a centralized, organization, there's a disconnection there. People that are talking to them lose empathy. They do the same thing. It's hard to infer tone. You have all sorts of communication breakdown and a lot of noise that gets in between you and that driver if you are trying to communicate with them, and they have the same exact thing coming back this way. So they're constantly trying to figure out where they stand. You're constantly trying to just figure out where they are. And that makes things challenging, which leads to these high turnover rates.
Yeah.
The easiest thing that you can do to maintain a driver is you don't have to pay them a lot more. You just need to make sure that they are happy and feel good about their situation.
And I think from what I can tell, a lot of it comes down to just simple communication, right? I mean, when we've seen different stories break throughout last year, a lot of it just came down to communication, where the drivers, the heart of the company, were really the last ones in line to know about any major changes. And it's just like they are the lifeblood of not only the country but the company. They're
the reason.
They're the reason, and they're the last. And so I think a little bit of respect and a little bit of communication goes a very long way with them. And I mean, Wayne Craig says driving schools can only pull from a barrel so long until you get to the bottom. Are we finally seeing the negative results of over 100% turnover for a decade? I believe so. That's what he says.
And this is going to continue to be a problem. So what's some of the ways that we can, if you are a carrier with a small fleets don't necessarily have as much trouble with this because that's typically a much more desirable position. Private fleets, not necessarily the same thing either because you get more dedicated runs, which is, again, a little bit more desirable. But that over-the-road sector, which is, of course, the thing we talk about largely on Freightonomics, for hire, over-the-road driving, has been, really subject to a lot of variance over the last bit. How do you pick what's the right amount of drivers that I'm going to have? If you look at the last 3 years, Anthony,
very different situations,
and you pick the midline and all that, you're still not going to get the right answer. You're still going to miss a ton of opportunities on the upside, and you're going to cost a ton of money on the downside.
Right.
If you were to pick the midline. So the midline, if anybody's been in transportation management classes or supply chain classes, there is this little graph that they show you, and it's so pretty, and it's so easy to look at in theory and on, in these classes.
Also, in economics, this might be equilibrium.
They're always, I love how they're always so perfectly drawn.
Yeah.
And it's like this sine wave that's just like this little curvy line, and it's got, a high point and a low point line, and they're just perfectly straight lines because they never change, right? And that's something that is very hard to visually depict. And that's not reality.
Right.
Everybody says, if you're looking at one of these graphs and you see the stock market, for instance, and you see this thing going up and down and up and down and up and down, how do you pick the right number for something that varies, 20 to 30% every year?
All speculation.
And that's exactly what we've seen the last 3 years in a row now. We have seen significant capacity changes of 20 to 30%. We get a bunch of money, hire a bunch of drivers in 2018, oversaturate the market in 2019. A bunch of people start exiting the market end of 2019, early 2018. COVID hits even more.
Yeah.
And then all of a sudden demand comes back online, and then everybody starts scrambling to try to staff back up again, and they just can't. It's so slow. And I guess what will be interesting to see, and I think everybody's in agreement that here over the next few months, fourth quarter peak is probably going to continue to keep this market at a very record tight level. I think the interesting thing to see is, and this is one of the solutions for, the current market, where I think we are seeing somewhat of a driver shortage, buzzword alert. That if the demand subsides and cools off, like it inevitably will, as everybody moves back towards equilibrium, and gets used to this post-COVID world, and of course the pandemic hopefully will be subsiding at some point in the next 2 years. What will that do? Will we have overhired again?
Well, I think the thing I'm really happy for within the industry is that ease of entry and exit, because I think it's easier to move to that equilibrium instead of putting in some kind of parameters that makes entry or exiting, becoming a driver into the market harder. Also, I don't know if driver age, median age is starting to kind of creep up there, but I think we also need to do a better job of pushing some trades and some other skills for younger individuals. College isn't for everybody. Not everyone should be going to college, racking up a whole bunch of debt. A lot of people become millionaires and entrepreneurs without college. And so, I think...
Well, that's a whole nother subject we should dive into.
I could go into a rant on that. We're looking at macroeconomics and employment and labor trends, but definitely interested in seeing kind of how some of the younger generations get recruited into the workforce when we're looking at what's going on here. But definitely thankful for some of those ease of entries and exits. But...
yeah, and that's, the fact that it has become a little bit tougher to make those hires, I think, is going to contribute, into 2021 for sure, even though demand will probably subside a little bit. Well, that'll wrap up our show for today. Thank you, of course, for watching. And be sure to download the FreightWaves TV app on podcast players everywhere. Just look up Freightonomics or look up Freightcasts and get every FreightWaves podcast so you can be totally immersed in all things freight.
The FreightWaves ecosystem.
Yeah, and just learn as much as you can so you can do the best that you can in the world. Anthony Smith.
Drink more water.
Drink water.
I think you had enough. Drink a little bit more.
You know, this tropical season's been a thing too.